Now, in financial news, Korea's banking industry has been going through massive restructuring of late on slumping profitability, this in the face of slow growth and a low interest rate trend. But that doesn't really explain why some lending global banks are weathering the changes so well, while so many Korean banks are struggling just to keep their heads above water. Hwang Ji-hye explains.
Here in Yeouido, known as the Korean Wall Street, very few people are getting new jobs, with many banks downsizing as they watch their profits slump. Citibank Korea, for example, received the voluntary resignations of 650 employees late last month, or 15% of the total staff number. Local banks' combined profits dropped to roughly $3.8 billion last year, representing only a third of the profits the banks posted 2 years ago. Many point to slow growth and the low interest rate trend for the shrinking profits, which have hurt the banking sector's traditional cash cow, the interest margin. But over the same period, the world's top 1,000 banks saw their profits hit an all-time high of $920 billion, up more than 20% from 2012. So what's causing the gap between global leaders and local banks? Experts say that banks in Korea are too dependent on the easy way of making money, the interest margin, and aren't focusing enough of their energy on new business opportunities. While on average half of the profits at foreign banks comes from the interest margin, nearly 90% of the local banks' profits come from the difference in interest rates. Tight government regulations are another reason.
The financial industry is heavily affected by government regulations, but they were tightened after the Asian financial crisis, which prompted the industry to lose vitality and fail to actively penetrate overseas markets.
While the nation's financial regulator did lay out plans last week to remove regulatory hurdles in the financial sector, experts add that more efforts are needed to breathe life into the industry. Hwang Ji-hye, Arirang News.